Hey guys, so my name is Dr. Baloch and I'm a first year, I just graduated medical school. I have a lot of student loans and I've been searching on the internet trying to figure out what to do with my loans. There's some comprehensive guides that you can read, there's some books that you can read. I would really suggest benwhite.com, he has a great book, and The White Coat Investor, great resources. I'm just trying to kind of condense that information down into like a really easy to understand format, and I've added a couple Excel sheets that you can use. So that's what, if you have like this loan consultation that you can purchase or pay for, they just put your numbers into an Excel sheet and they can tell you what to do with your loans, whether to do pay, whether to do repay, whether to refinance, whether you want to do public service loan forgiveness, all these things. So first things first, I want to talk about is public service loan forgiveness. Should you do it? Is it important? I'm going to say the first consideration should be, if you're going to be working in a nonprofit no matter what, you should do public service loan forgiveness. You don't lose anything from doing it. But if you're considering private practice, then you do lose something because oftentimes salaries in private practice are higher. So I've made a little Excel sheet calculator. You can put in all your information into that calculator and you can see, well, how much income did I lose by working in a nonprofit, and how much did I gain by loan forgiveness. So should you do PSLF, right? First of all, you want to do a virtual loan consolidation. You put in all your loans and it tells you that this is going to be your loan total and this is going to be your interest rate. And how I have that set in the Excel sheet is you just add up your loans, it weighs the interest rates, and it gives you a total interest rate. So for my situation, these are my loans, this is my interest rate. Okay, and then we have to estimate our standard payment. So we go to this government website and you put in, it has all your information, has all your loans on there. It gives you a standard monthly payment. Standard monthly payment is important because, for example, for pay, that's capped. The pay is capped. You'll never have to pay more than this amount for income-based repayment in the pay plan. Okay, so let's take a look at a couple of examples, and these are just a couple of examples. The Excel sheet's going to be linked down below. You can put in your information. Okay, so I looked at the difference between somebody doing private practice versus somebody doing academics, which would usually qualify you for PSLF. And in this case, private practice will get you $257,000. Academics will get you $181,000. So in a married filing jointly situation, that is difference in $56,700 approximately post taxes. And you have to look at post taxes because that's the money that you get to take home with you. So that's the extra money that you make by doing private practice. A good way to find out is this website called smartasset.com. You put in your information for what state you live in. So for example, I'm in Florida. And so you put in the household income and you look at the take-home pay, okay? And then you look at the take-home pay in the private practice situation, and then you look at the difference and you see, well, how much extra did I make, right? So we'll take these numbers over, 181, 481, we'll take them over to our Excel sheet. So first of all, we go to 3-year training. So I've set this up for 3, 4, 5, 6, 7 years of training. And honestly, if you're going beyond that much training, more than 7 years of training, you're going to do PSLF. I mean, it's worth it at that point. But so how this works, how this Excel sheet works, you type in your salary in which you would make in PSLF. So in this case, it would be 181,000, and then you type in your delta. Your delta is going to be what your difference would be if you were to do private practice, and you can put it in for married, or you can put it in for single, depending on if you're married or single, and it'll calculate a different amount for you down here. The other things that you have to input is your salary. So this is it's found on the GMU website of your residency program usually. So you type in whatever salary that you're going to make for the first 3 years, or depending on the length of your residency training, you type that in, and it calculates the rest for you. You don't have to worry about anything else. So you have to put in your starting balance over here as well. So my starting balance is 311,000. Your starting balance might be less. So in this example, we're doing somebody that has $200,000 in loans. Okay, so let's type that in, $200,000 in loans. Okay, so let's see, was PSLF worth it for this person? At the interest rate of 6.5%, what this shows you at the end of residency, at the end of 3 years, if you were doing an income-based repayment plan, your total loan remaining, and this is on repay, so you have an interest subsidy, you don't pay all the interest.
your total loan payment is going to balloon to 222,000. Okay, so what this calculator is going to look at is if you were to take this 222,000 and you were to refinance it at a rate of 3% over the remaining 7 years. So 10 years till you pay off this loan refinancing, 10 years till you pay off this loan doing PSLF. You would end up paying, with interest, your $200,000 in loans will end up costing you $247,000 in loans. Okay. But how much income did you lose? Well, the first 3 years you don't lose anything because you're still in residency. But then you start losing income every year because you're making less in the PSLF job versus in private practice. So what this calculates is, at the end of 10 years, you lost $434,000 in income. Plus, you lost another $120,000 of the payments that you made, because you still have to make a certain amount of payments to qualify for the student loan repayment, right? So this person ends up making $120,000 in payments for student loan forgiveness, for qualifying payments towards PSLF. And so the total cost of going to the PSLF program is going to be $554,000. And how much loan was forgiven? Well, if you just paid it off yourself, interest included, you would have paid $247,000 out of pocket. That means over here, you don't have to do any calculations. It's amazing. $307,000. This is what you lost. This person with this loans, with this much of a gap between PSLF versus private or PSLF eligible job versus private practice, would lose $300,000 doing PSLF. It's not worth it for this person. Now let's just change the numbers. Say the same person, instead of $200,000, had $400,000 in loans. Well, now this person would still lose, but would only lose about $63,000. So you can, and just playing around with the numbers. Let's say the private practice job that you found only pays $20,000 more than an equivalent job than a job that's eligible for PSLF. Well, let's put in $20,000, and see how a difference that makes. This means that now doing PSLF with $400,000 in loans, and the delta is only $20,000 a year, you actually make $217,000 doing PSLF. Now, this is kind of an extreme case scenario where you have a lot of loans and the delta isn't that big. So you just have to kind of work it out for yourself, and this calculator is great for that, depending on what your training you have, et cetera, et cetera. So if you have a longer training program, I'm not going to go through all these scenarios. It's available for you, and you can check it out yourself. So what I want to talk about now is should you do pay versus repay, right? So here's the kind of key points. Repay is great because 50% of your unpaid interest is subsidized. Okay, so not all the interest is subsidized. It's 50% of your unpaid interest. So if your interest is accumulating, for example, at the rate of $3,000 a month, and you pay $300 towards that, well, the $2,700 that's remaining, the government will forgive half of the interest. And the plus side is that in these programs, interest is not capitalized. So what that means is, in certain loans, like for example, credit card loans, you have, say you take $1,000 out, and then your interest builds up, right? And then initially you pay interest on $1,000. Then after a while, your loan gets higher and higher because your interest is building up, and say you're not making payments on time, or you're not making payments enough to cover the interest plus the principal. Your loan has now increased to $1,500, for example. Now the interest is going to be even higher because you're going to pay interest on the $1,000 plus the $500 interest that you've accrued. It gets added to the principal. In repay, that doesn't happen. In pay as well, that doesn't happen. So that's good because your interest accumulates kind of on the side, but you only get charged interest on your initial principal balance. And then the disadvantage of repay is that it takes your spousal income into account. So how these programs work is you take your salary, right? Whatever, let's say you make $55,000 a year, and then you subtract it from 150% of the federal poverty line. So what you can do to find that is you go look it up on the internet, and for a person of two, 150% federal poverty line is 25,860. Let's keep it simple, okay? Let's say somebody's making $50,000 a year, and the federal poverty line is 25,000. That means the income that you're going to have to pay your payments on is $25,000 a year. $25,000 a year, and you have to pay 10% of that. So that's $2,500 a year. And you divide that by 12, and you get an approximate payment. You get an approximate payment of $208 of. So that's what you pay. And the difference between repay and pay is that repay is not capped. So let's say instead of 55,000, now you're attending and you're making $300,000 a year. Well, a repay doesn't get capped. You're always going to pay 10% of. So I'm just going to ignore the poverty guideline. You have to factor that in when you're calculating the amounts. But at 30,000, 10% of 300,000 as your income is $30,000, and then so you're going to end up paying 30,000 every year, and so your monthly payment is going to be about $2,500 a year. And like I mentioned initially, it was important to look at your monthly payment for the standard plan, which is $2,596 in my case. It would be higher with the higher loan amount, and it would be lower with the lower loan amount. But your loan amount does not matter for pay or repay, only what you make, because it's income-based repayment. So if you're trying to do a public service loan forgiveness, your goal is to minimize your payments as much as possible. And the other advantage of pay versus repay is that in pay, you can separate your spousal income. So you don't have to pay, if your spouse is making more money, repay will take that money into account and you'll have to pay more money. It takes your household income into account. Whereas pay, you can file separately from your spouse and make and that'll give you a smaller payment. And especially so if you're going towards the PSLF, the smaller payments are better because it doesn't matter how much interest you accrue. All only matters is you want to make the smallest amount of payment possible for 10 years, and then everything else gets forgiven. So one specific thing that I want to touch on is pay versus repay for married residents. So I'll kind of just read through this slide that I prepared, but if you're doing repay, your spousal income gets taken into account. If you're doing pay and filing jointly, your spousal income gets taken into account. So this is kind of specifically for married residents. It can also apply for if you have a spouse that has student loans for some other program. But how this works is they combine your household income, and then they subtract the poverty level from it. They take the 10% of that, and then they look at the percentage of the loans versus the household loans. So if you both have equal amounts of loans, it doesn't matter. But let's say one spouse has $300,000 worth of loans, the other spouse has $100,000 worth of loans. So your household income is going to be $55,000 each, so $110,000, and the combined payment for this person, this kind of thing, would be $701. Now, each spouse is going to pay proportionately to what their balance is. So the math actually is actually a little incorrect here. It would actually be 25%. So 701. Person would pay 20. So one person would pay 175, and another person would pay the rest. But the combined is still $701. Now, if you were to do pay married filing separately, you would both pay $242 each, $484 total. So what you have to do if you're married to a resident, you have to go into that calculator. You just have to calculate what your amounts are going to be, and just kind of see how you can figure out the lowest amount, because you can do it separately, where one person can do repay, one person can do pay. So you just have to figure out how it's going to be. You put in the numbers, and you have to figure out what's going to be the lower amount. And so if pay is lower for one person, so you do the pay. If the repay is lower for the other person, they do the repay. And you just want to minimize your payments. This is, again, for public service loan forgiveness.
So coming down to the grand scheme of things, what should you do? These are the kind of steps that you should take. Step number one, consolidate your loans. Okay, you're not eligible for PSLF unless your loans are consolidated. So consolidate your loans. Step 2, plan for PSLF. I say this because during residency, it does not matter if you're planning for PSLF or not. So how you plan for PSLF is you do the repay plan. The repay plan, because it saves you on interest. You save half the interest, it's great, and half the unpaid interest. And you can switch from repay to pay. So the advantage of switching from repay to pay, why would you want to do that? Well, if you stay on repay and you still want to do PSLF, it doesn't make sense to stay on repay because repay, the payments are not capped. So let's say you're in kind of a lucrative field or you make more money, making like $400,000 a year. Under repay, your payments are going to go higher than the standard 10-year amount. Under pay, those payments are capped. So what's the disadvantage? Like, why can't, like, well, there has to be some disadvantage of being able to switch. The disadvantage is all the interest that you've accumulated for the 3 years, 4 years, 5 years, whatever amount of time you were in residency gets added to the principal, and now you're going to get charged interest on the interest plus the principal that's been accumulating for those 3-4 years. But that doesn't matter if you're going to do PSLF, right? It doesn't matter how much interest they charge you. Only thing that matters is the amount of payments that you make, and you try to minimize the payments because at the end of the 10 years, everything gets forgiven. Whether you accumulated $100,000 worth of interest versus $300,000 worth of interest in extreme numbers, it doesn't matter. All that's going to get forgiven, and there's no tax. You don't have to pay taxes on it, so it doesn't. None of that matters. So, okay. So you consolidate your loans, you plan for PSLF, you sign up for repay. No matter what, you sign up for repay, okay? Unless, out the gate, you have a spouse that's making a lot of money and then your income level is going to be higher. So then you can, household income level is going to be higher. Then you can plan for pay at that point. But ideally, most people should plan for repay. It'll save you on the interest. And then when you get to the end of your residency, if you're not going to do PSLF, okay, you at the end of your residency, you look at what's paying more, what's paying less, what's worth it to you. You keep this calculator, you put in the numbers again, and if it works out for you, go ahead and do the PSLF. You switch to pay at that point. You switch out of repay, you switch to pay, and then you make your minimum possible payment for 10 years. You get your loan forgiveness. You're good to go. If not, if you decide you don't want to do PSLF, your field is not going to be good for PSLF, at that point you shop around for the lowest interest rate and you refinance. And when you refinance, you just pay off your loans as aggressively as possible. I've tried to cover all the points. I've tried to cover when you should do pay versus repay. I've tried to cover PSLF, if you should do it or not. I've tried to cover what might be different for people that are married, what might be different for people that are married to residents or married to other people that are doctors. If there's any other questions that you guys have, you can post them in the comments below, and I can definitely try to help you figure out the situation. I would also suggest that you check out The White Coat Investor and benwhite.com. Ben White's book is great. I read that book and got a lot of information from it. Thanks for watching this video, and if you guys have any suggestions and what I can do to make it better, if you would like any other videos on different topic about student loans or anything else, please let me know, and I can look into it. Thank you. Have a good day.